Welcome to my YouTube channel Zest Invision. To watch more informative videos, subscribe my YouTube channel. The history of insurance dates back thousands of years, evolving from ancient practices to the sophisticated systems we have today. The concept of insurance emerged from a need to mitigate risks and losses that individuals and communities faced. Ancient practices. Insurance-like practices can be traced back to ancient civilizations. Babylonians around 1750 BC had a form of insurance in the Code of Hammurabi, which included provisions for merchants to pay lenders an additional sum to cancel a loan if their shipment was lost. Marine insurance in ancient times. Marine insurance has ancient origins. In the Mediterranean, Phoenician traders often took loans to finance their voyages, and if a ship was lost, the loans would be cancelled, functioning as a form of insurance. Guilds and mutual aid. During the Middle Ages, guilds and trade associations in Europe provided a form of insurance for their members. If a member suffered a loss, the community would come together to provide financial support. Lloyd's of London. Lloyd's of London, established in the 17th century, is a well-known institution in the history of insurance. It began as a coffeehouse where shipowners and merchants met to discuss and underwrite marine insurance. It later evolved into a major insurance market. Fire insurance. After the Great Fire of London in 1666, which devastated the city, fire insurance became more prevalent. Various companies were established to provide insurance against fire-related losses. Insurance in the 18th and 19th centuries. The 18th and 19th centuries saw the emergence of numerous insurance companies offering a range of policies covering life, property, and various other risks. The Industrial Revolution and increased trade necessitated more comprehensive insurance solutions. Government regulation and modernization. In the late 19th and early 20th centuries, governments began to regulate the insurance industry more closely to protect policyholders and ensure stability. Insurance companies diversified their offerings and refined risk assessment techniques. Ancient practices related to risk management and early forms of insurance can be traced back thousands of years to various ancient civilizations. While these practices may not resemble modern insurance as we know it today, they serve the purpose of managing risks and providing some form of protection or assistance to individuals and communities. Here are some ancient practices related to risk management. Babylonian Code of Hammurabi, circa 1750 BC. The Code of Hammurabi, one of the earliest known legal codes, included provisions related to commerce and trade. It mentioned a form of insurance where merchants would pay an additional sum to cancel a loan if their goods were lost in transit due to specified hazards. This can be seen as a primitive form of insurance to mitigate the risks associated with trade and transportation. Chinese and Babylonian traders, 3rd millennium BC. Traders in ancient China and Babylon often pooled their goods in caravans to distribute the risks of theft or damage during transport. In case of a loss suffered by one trader, the others would share the burden, demonstrating a form of risk sharing or risk pooling. Greek and Roman benevolent societies. Ancient Greek and Roman societies had various groups and associations that provided mutual aid and financial assistance to members in times of need, such as during sickness, funeral expenses, or other emergencies. Members would contribute to a common fund, and the funds would be used to support those in distress. Marine insurance in ancient Greece, circa 300 BC. Ancient Greeks engaged in practices that were akin to maritime loans. Shipowners would seek loans to finance their voyages, and if the ship successfully completed the journey, the lenders were repaid. However, if the ship was lost, the loan would be forgiven, somewhat resembling a form of insurance. Roman burial societies. In ancient Rome, burial societies existed where individuals could contribute funds to cover funeral expenses. These societies helped members manage the financial risk associated with burial costs. Middle Eastern caravans and trade contracts. In regions like the Middle East, traders and caravan merchants engaged in trade contracts that included provisions for shared risk. Contracts would outline how losses would be shared in case of theft, natural disasters, or other unforeseen events during their trade expeditions. These ancient practices laid the groundwork for risk management and the concept of sharing risks within a community. Over time, these concepts evolved and became more structured, eventually leading to the development of modern insurance as we know it today, with sophisticated policies, risk assessment methodologies, and regulatory frameworks. User Health and liability insurance. ChatGPT. Health insurance and liability insurance are two essential types of insurance that provide financial protection and risk management in specific domains. Let's explore each type. Health insurance. Health insurance is a type of insurance coverage that pays for medical and surgical expenses incurred by the insured individual. It helps in managing the financial risk associated with healthcare expenses, including doctor visits, hospital stays, prescription medications, preventive care, and other medical services. Health insurance provides coverage for both preventive and curative healthcare needs. Key features of health insurance. Premiums. Insured individuals pay regular premiums, monthly, quarterly, or annually, to maintain their health insurance coverage. Coverage types. Health Maintenance Organization, HMO, provides coverage for in-network healthcare providers and requires a primary care physician referral for specialist visits. Preferred Provider Organization, PPO, offers coverage for both in-network and out-of-network healthcare providers, with more flexibility in choosing doctors and specialists. Exclusive Provider Organization, EPO, covers only in-network healthcare providers, except in cases of emergencies. Point of Service, POS, combines features of HMO and PPO plans, requiring a primary care physician referral but allowing some out-of-network coverage. Deductibles, copayments, and coinsurance. Insured individuals may have to pay a deductible, a set amount, before the insurance starts covering costs. Copayments and coinsurance are the portion of costs paid by the insured after meeting the deductible. Prescription drug coverage. Many health insurance plans include coverage for prescription medications. Preventive care. Health insurance often covers preventive services like vaccinations, screenings, and checkups at no additional cost to encourage early detection and disease prevention. Networks. Health insurance plans often have a network of healthcare providers with whom they have negotiated lower rates. Using in-network providers usually results in lower out-of-pocket costs for the insured. Thanks for watching my videos.